It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. It is podcast time to manage your financial future, which, oddly enough, that's also the name of this particular podcast. Managing your financial future. We do our best to help inform you about different financial topics, about different financial strategies, and we try to offer potential solutions to whatever issues you may have. I'm Johnny Dean. I am the moderator of this particular podcast. I'm not the advisor, but I do have the advisor portion of the team here with me. Longtime co-worker, and actually, as it turns out, fairly nice guy. I've come to determine this, Professor Rick Plum.
Don't let those rumors get out.
Well, I know I've been fighting those, but after 20-something years of hanging out with you here, I've decided you're not as bad a guy as you think you are. Yeah, you're a nice guy. You really are.
I have my moments.
Well, you do. As you get older, I think you just the edges tend to soften a little bit. You might get a little more cynical, but at the same time, you find that life's going to be too short for you to care about the little stuff. So anyway, Rick, Certified Financial Planner Professional, CFP for short, and you've been doing this for a really long time, as I like to tell people. And I found experience, by the way, Rick, is crucial when you're talking about real-world situations like the ones we're going to get into today. Sometimes you read it one way or you learn about it one way, and you think, yeah, this is the way it is. But when you get into real life situations, it's not always the same. Do you think that?
I think knowing the history of things allows you to understand it a little bit better in many cases, especially when it comes to tax law and the way that they set up things for, why we do what we do as far as IRAs, pension plans, things of that nature. Just trying to memorize them as they are today is one way. But if you understand the history of where we've come from, it makes things make a little bit more sense in some cases.
Oh, absolutely.
Or not.
Well, you do have it both ways. Now, you mentioned history. Let's go into the Wayback Machine. I'm going to go back to 1998. Okay, not literally. I'll be talking about it. 1998. You know what happened in 1998? Here are a few things. Did you know Google was founded in 1998? We had no Google prior to 1998. Sometime during the year, Larry Page and I forget the other guy's name. Anyway. Stanford PhD students, they started Google. How about that? Who knew?
Okay. That was an impressive
unfortunately,
year.
I had to look that up. I didn't know it was 1998. Titanic was all over the Oscars.
Still have never seen it.
You're not missing anything. And the trouble was, I went into it, I already knew how it ended, you see?
I think most people did.
If you don't want to know how Titanic ended, turn it off now. The ship sinks. Okay. What else? Oh, a few other things. The Europeans agreed on the common currency of the euro.
That started in 98?
Well, it debuted in 1999, but they decided in 1998, yeah, we're gonna I think it was January 1, 1999.
Seems like that's been around for longer than that, longer than 21 years.
Yeah, but that's when it was. And speaking of money, guess what else happened in 1998? The American public, huh?
Yeah. There were two big tax changes that I can remember.
Well, there were. The American public was introduced to I guess it's a brand new concept, and it was in personal finance, called the Roth IRA. It was part of the Taxpayer Relief Act of 1997, and I didn't remember that title, but that's what it was. And the Roth IRA is named for Senator William IRA. No, I'm kidding. William Roth. Bill, as we call him, Bill Roth. That's really all the history you're going to get on this, because we have some other important things to talk about. But it hasn't been around. It's relatively new.
Right. The Roth IRA first became available in 1998. And what it did was it took a traditional IRA and completely flipped it around.
Yeah, it's like a regular IRA is sort of the inside out opposite day version of an IRA, a traditional IRA. So if you would, Professor Plum, please compare the two. Let's talk about traditional versus Roth and how they differ mostly.
Well, the way I look at it, there's three components or three time zones, three periods of time, whatever you want to call it, that an IRA has. There is the contribution, the money that goes into it. There is the deferral period. And then there's the end when the money comes out. And with the traditional IRA and the Roth IRA, they're exactly backwards. With a traditional IRA, normally most people that do a traditional IRA contribution are doing it so that they can get a tax deduction. Not everybody can get a tax deduction. You can still do a non-deductible IRA, although they aren't as fun unless you're doing something else like converting it to a Roth. But in a traditional sense, the reason we do IRAs is to get an immediate tax deduction. The money in the growth period, hopefully the deferral period, there's no taxes to be paid while we're waiting for the money to, call it mature, whatever you want to call it, until we get older and we want to retire. And then when we get to retire, once we're over 59 and a half, we can take the money out and it'll be taxable then. So there's no tax during the deferral. There's a tax deduction going in. The Roth IRA is kind of the exact opposite of the traditional IRA. Traditional IRA, tax deduction up front. Roth IRA, no tax deduction up front. Both of them have no taxes while the money is maturing, seasoning, whatever you want to call it, between the time you put the money in and when you ultimately retire. And then at the end, when you take the money out, traditional IRA, you pay taxes on the money then. Roth IRA, tax-free.
So if I have a bunch of stocks, or I'm doing a bunch of trading in my traditional IRA, I could have gain in my IRA and yet not pay any taxes on it until it comes out. Is that what you're saying?
Whether it's a traditional IRA or a Roth IRA, whatever taxable event is generated, for the most part, capital gain, interest, dividends, all those types of normal taxable events that would happen if it was not in an IRA, those are all tax deferred. You don't pay taxes on it until later on. And with a Roth IRA, if you wait long enough, 59 and a half and 5 years from when you first started your Roth IRA, it won't even be taxable then.
Yeah.
So it's a matter of, you got a tax deduction or not. You get taxable retirement income or not. So which do you want to do? Which one makes more sense? Now, I was talking to a client just the other day about this, a younger person that was starting out. And the question is, they were in a decent tax bracket. They were making pretty good money. And so the tax deduction, it mattered. And the one other thing about the Roth IRA is that it is more flexible. What I mean by that is it allows you to take distributions. And this is both a good and a bad thing. When you put money into a traditional IRA, especially if you've taken a deduction for the contribution going in, there's this big tax wall and a penalty wall between you and that money. It's tough to get to the money. When you take the money out of an IRA, if you're not 59 and a half, whatever is taxable in there, and that contribution that you took a tax deduction for will be taxable when you take it out. That not only is taxable when you take it out, but it's penalized if you're under 59 and a half. With a Roth IRA, if I need to take money out of my Roth IRA, I can take out the contributions that I've put in. So there's an accounting ledger on the side that says you've been putting in $6,000 a year for the past 5 years. You've put $30,000 of your own money after tax into this Roth IRA. Maybe it's worth 40, 45,000 or something. It's grown a little bit here and there. But you can take that 30,000 out for any reason at any time, and it's not taxable and it's not penalized. You've been putting money in, you can take that contribution money out. And so it creates this flexibility that especially for young people that are just starting savings, but they want to have an emergency fund, but they also want to have a Roth IRA. Fine, start your Roth IRA, use it as your emergency fund, invest it appropriately for safety. And then as you get better, you've started your time horizon, you've got the money in, you've got money in your Roth, and hopefully you didn't have an emergency. And so you don't have money sitting on the outside. You've got it sitting in a Roth, and you can go from there.
Now, many people might look at a Roth IRA and say, well, tax-free, that would be better, I would think. But, Professor, I would guess there are times when you should consider a Roth, or maybe a traditional would work better. How do you determine which one is better for an individual? Are there any rules of thumb on this?
Well, the rules of thumb are tough, because one of the sides of the rules of thumb make you look into the future and project at what your potential future tax bracket is going to be. And so I remember I was talking to this nice lady. She was about 54 years old, and she was basically just now getting started on saving. And she was making, $60,000-$70,000 a year, single individual. She was in the 22% bracket. She was in a state that had an income tax bracket. So she was paying 25, 27% taxes on the money she was making. She could do a traditional IRA contribution and save 25%, save some money. So if she put 6,000 in, she'd save about $1,500 in taxes. And that meant a lot to her right now. But on the other side, when she retires, if she's putting $6,000 into her IRA for the next 20 years, she's going to build it up to be a couple $100,000. It's unless she has extremely good experience with investing, she's probably going to have $250,000. Not bad number, but that's going to create a distribution of 10 grand or so. And when she takes the money out of her IRA, unless they completely turn the tax code on its end, it's pretty much going to be tax-free when she takes it out, or very low on the tax scale when she takes it out. So in her case, she can save 25% today and probably pay 10, 12% when she takes it out. That makes sense, getting the tax deduction today. On the other hand, I've seen other people who already have a ton of money in their 401ks or IRAs. They've got large pensions. They're going to have large pensions. And their question is, well, they're in a 25, 20, or 22, 24% bracket today, and they're going to be in the same bracket, when they retire, because they're going to have great pensions. Well, wouldn't it be nice to have the ability to withdraw tax-free money in that case? So from a rule of thumb, if you're in a higher tax bracket today than you're going to be in retirement, then you lean towards the traditional IRA. If you're going to be in the same tax bracket or higher tax bracket when you retire, and there are people that are in that situation, then the Roth makes sense. Now, on the other side, we've talked about the ability to make a contribution to a traditional IRA and deduct it. Not everybody can deduct the contribution to a traditional IRA. If you are working, you can make a contribution to an IRA, but you may not be able to deduct it. There are income limits if you have a retirement plan at work. If you do not have a retirement plan at work, it doesn't matter how much money you make, you can do a deductible traditional IRA. But if you are a participant in a 401k, you have a pension at work or some other kind of retirement plan at work, if you make more than X amount of dollars, that depends on whether you're married or single, then you lose the ability to do a deductible contribution. You can still make the contribution, you just can't deduct it. And I'm not that excited about that issue of making a non-deductible contribution. But so we have to understand. So if you are in that situation where, married couple, you have a job, between the two of you, you're the two spouses, you make more than $125,000 a year, and you have a 401k pension plan or something at work, you can't do a deductible contribution to an IRA. So if I can't do the deduction, and if I'm going to make an after-tax contribution, and I'm still within the tax or the income limits to do a Roth IRA, a Roth IRA makes sense. I mean, if I'm going to make the contribution and not get a deduction anyway, I might as well get it into a Roth IRA and get tax-free in the future rather than taxable earnings. I like that idea. So it's all about A, can I take the deduction? B, what's my tax bracket today? C, what's my potential tax bracket in retirement?
So if I'm understanding what you're saying, it's tax bracket really is the most important, or maybe the determining factor. Is that right?
Whether it's a determining factor, it is a driving factor one way or the other. In many cases, where somebody's in a bracket, maybe they're in the 12, even the 22% bracket, and they're looking at it going, the tax deduction would be nice, but that flexibility of being able to get to the money,
right.
I've got young kids, and who knows what's going to happen in the future. And if I need money, where am I going to get it from? The Roth can make a lot of sense in that case. So the flexibility may be the deciding factor between Roth and traditional. Other people, the deciding factor is purely tax brackets.
I thought I heard you say one time that there are income limits, Professor, when it comes to being able to contribute to a Roth IRA. There
are income limits when it comes to contributing to a Roth IRA, and they are higher than the income limits for deducting a traditional IRA contribution. So it's just a matter of where we are, what we're trying to accomplish, where we are on the income scales, and what options are actually available to us.
All right. So if you make too much money, does this mean you can never get money into a Roth IRA?
Well, contributing money is only one way to get money into a Roth IRA. There are actually two ways to get money into a Roth IRA. One is to make contributions. Contributions come from your pocket, your checkbook, your earnings. You've already paid tax on the money, you're putting it in. The other way to get money into a Roth IRA is to take existing tax-deferred IRA, 401k, retirement plan money and convert it from that existing IRA retirement plan over to a Roth IRA. When you do that, you pay taxes on the money, but now it's in the Roth IRA. From here forward, will be part of the potential tax-free benefit of the Roth IRA.
So it doesn't matter how much you make, whether you don't make any money at all, or you're making, $5 million a year. Is that the deal?
Doesn't matter anymore. When Roth IRAs first came out in 1998, to do a conversion, you had to have an adjusted gross income, not including the conversion, of less than 100,000 or less. Being the cynic I am, I think Congress looked at it and said, not enough people are converting money. We're not getting enough tax revenue to balance our budget ideas that we want to show. So let's open the books up and let anybody do a Roth conversion. That was 20 years ago. And so since then, anybody, regardless of their income limits or their income levels, can do a Roth conversion. And the key here is you do not have to have earned income to do a conversion. You have to have earned income. You have to have a job, self-employment income, something of that nature, to contribute new money to the retirement world. But money that's already in the retirement world, 401k, IRA, that can be converted whether you have a job or not. So even retirees who do not have a job, I was talking with somebody the other day who's 81 years old, and this year they're going to be in a fairly low tax bracket, and they're looking, well, I'm probably never going to use this IRA money anyway. I don't have an RMD this year, so hey, maybe I'll take some of this money and convert it to a Roth IRA, and I'll pay the taxes now, but my kids are in a much higher tax bracket. They're the ones that are going to get the money anyway. So from them, it made sense to do a conversion. They haven't had a job for 20 years, and they're doing conversions.
Hey, get a job, will you? I remember listening to radio ads back in the late 1990s. Do you remember these that were saying they were running ads about Roth IRAs and converting money to Roths, and it seemed like they said everybody should be doing this, but not everybody should be doing this. Am I correct in saying that?
Well, I mean, yes, you're correct in saying that. It's like anything else. We've done this podcast on this. Whenever you hear the word always do this or never do that or everybody should do this or nobody should ever do that, the answer is probably not a real statement. I mean, somebody's exaggerating here or there. It can be helpful, but it doesn't mean, unfortunately, we saw it when they first came out in 1998, we had the ability to spread the taxation of a conversion over 4 tax years. So in 1998, if I had done a $100,000 Roth conversion, I didn't have to pay taxes on all $100,000 in 1998. I was able to pay taxes on $25,000 in 98, $20,000 in 99, $2,000 in 2001. So it may have helped me get away from what's known as bracket creep. I may have not jumped myself into another tax bracket where 100,000 would most likely have pushed me into another tax bracket. The other one probably didn't. We've not had that for a while. We had a 2-year conversion a couple of years back, but right now, when you do a conversion, you pay the taxes in the year that the money is converted, that's when you show the taxable event. So it's all a matter of, should everybody do it? Well, no. I mean, I've seen people that have a couple $1 million in their Roth or in their traditional IRA. Doing that all at once would definitely put them in the 37% income tax bracket, where they may be able to, if they're young enough, they may be able to stretch out distributions or conversions over the next 20 years and stay in the 24% bracket. That's safe tax.
Oh yeah. Now I would assume that the addition of the Roth IRA gave advisors like you, now I'm not an advisor, but you are, gave advisors like you another tool, more opportunities to do some potential planning here.
Oh, definitely. More opportunities to confuse people, but obviously more opportunities to help people as well. Whenever there are more options, it gets more complex. And so that's why when you hear the thing, always do this, always do that, people are saying you don't even have an option. Let's just do it. No, there are options, and there are reasons to look at it and to dig down a little bit to see whether it's really in your best interest. But in many cases, especially for a retiree who already has maxed out their taxability of their Social Security, there may be some room left in the current tax bracket to convert. And converting, you're going to pay tax at that level anyway. So you might as well convert what you can, which will move growth over to the Roth IRA, which will reduce the traditional IRA. And reducing the traditional IRA also reduces the future required minimum distributions. So that can be a benefit and a game plan. So it's something to, I will use the word always for you. It's something to always look for. It's not necessarily something to always do.
Yeah, and the only way to really do that, I think, is to talk to your financial advisor, have them look over your situation.
Talk to somebody who knows the tax codes, knows where you are, knows how you're paying taxes on your Social Security right now. Was somebody brought in their tax returns and said, this is my normal tax return. Should I look at doing generating, pushing some income into this year, whether it be from an annuity they had deferred or from IRAs? And they were in the lower income levels where the majority of their income came from Social Security. I think they got $35,000 a year in Social Security, and only $1,000 of the Social Security was being taxed because they didn't have a lot of other income. So for every dollar that they were taking out of an IRA or an annuity, just for the fun of it, they were paying tax on not only that dollar of earnings that came out of the IRA or annuity, but 50 cents, soon to be 85 cents of Social Security that wasn't taxable before.
That sounds like something that could easily be overlooked by someone who's just doesn't know where to look.
Right. And so the first thing, you're going to look for is, where are you in the Social Security taxability scale? And how big is your IRA? I mean, if your IRA is, $100,000, you don't have to do a lot to make a big difference in the size of the IRA. If your IRA is $2 million, $3 million, well, most likely your Social Security is going to be taxable at 85% of it's going to be taxable anyway. So we're in the higher brackets already. So it's just a matter of where are we at? What are we affecting? Are we losing something on the tax code? Are we losing, deductions? Are we losing credits? Are we losing, XYZ? What is it going to cost us? That $1,000 conversion, you're in the 12% bracket. Why did my taxes go up by 1,800 or 18%, not 12%?
Have you seen that?
I've seen it go up quite a bit more than that in some cases.
Oh man!
Because once you get into the portion where you're paying taxes on up to 85% of your Social Security, you do a $10,000 conversion in the 12% bracket, but $18,500 of additional income is on the tax return, and you're paying 12% on $18,500, which comes out to about 22% if on that $10,000 of conversion you did. If your income you did 10,000 of conversion, your income went up by 18,500.
Yeah, and that's
because of Social Security.
And that's something that I think a lot of people may not be aware of, which is why it's helpful, I think, to have an advisor like you, Professor Rick Plum, go over some of this stuff. If you want to talk to Rick more about this, and Rick, you seem to have some knowledge on this subject, just as I'm listening to you. And as I said, experience counts, and just knowing where Roths come from, you've seen this over the last 22 now years plus, how they work, I think that's quite invaluable. You can get in touch with Professor Plum at Lucia Capital Group, 800-644-1150. I would suggest you give them a call, or any of the Lucia Capital Group advisors, really. They work. You're the Chief Financial Planning Officer, Professor, for Lucia Capital Group, but of course you oversee all the plans. But everybody, all the other advisors have access to you, and they can also, they know about this stuff. 800-644-1150. I would suggest you give Professor Plum a call and talk at least about whether or not a Roth may or may not be suitable for you, and find out about taxes and tax management. You can also get more information on us, by the way, on the podcast. This one here, you can go to our website, luciacap.com, Luciacap, luciacap.com, And as I said, you can reach Professor Plum that way as well. All right, we went a little over time, but that's fine because it's an important topic to get to. We're out of time right now. My thanks again to you, Professor Plum, certified financial planner professional. Me, the moderator, you, the advisor. It's kind of a nice little partnership, isn't it? Huh?
It works for me.
Works for me. Plus, I know how to operate all the buttons here, and so you wouldn't be able to get yourself on the podcast without me.
No, not a way. No chance.
That's right. 800-644-1150, the number at Lucia Capital Group, or as I said, luciacap.com. For Professor Plum, I'm Johnny Dean. This has been Managing Your Financial Future. Thanks so much for listening, and we'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and/or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.